morning and welcome to Charting the Markets on Monday, the 13th of November 2023. Now, today started off really interestingly on a political front in the United Kingdom with the Prime Minister Rishi Sunak firing his Home Secretary Suella Braverman after she'd made some comments which didn't go down too well with the UK population over the last few weeks. And interestingly enough, he replaced her with James Cleverly. But even more interestingly, he appointed a new foreign secretary. And this is David Cameron, the previous prime minister. Well, a previous prime minister and someone who hasn't been involved in politics for the last 7 years. So there seems to be a lot of political wrangling going on within the Tory party itself and within the right wing of that party. And on that news that David Cameron is now the new foreign secretary, the FTSE 100 did actually rally somewhat, as we can see here on their daily financial bet, as investors seem to think that he is somebody that other countries can easily do business with. And we'll have to see whether this upward momentum in the FTSE 100 can actually take us through this October to November downtrend line at 7,436. Because if that were to be the case, we could then head back up again towards last week's high and also the high seen the week before at the beginning of November at 7,484. And this we need to take out on a daily chart closing basis for us to have confirmed the end of this ABC, potentially Elliott wave correction that we've been in since the early November highs. And that would then indicate that the advance we've seen since the October lows is likely to take us all the way up to the red line here, the 200-day simply moving average, 7,611. And above there, we also have this cluster of resistance made up of the August, September, and also October highs between 7,702 and 47. But let's not jump the gun. As I say, from a technical perspective, the first thing we would need to see this week is a rise and daily chart close above that 1 month downtrend line, and then a rise above the 7,484 early November high for us to then head higher again. Now, with regards to support, there is a pretty good support line which was retested earlier this morning, which comes in between the early September and October lows between 7,384 and 69. That once again held. And we also have Friday's low at 7,320. So from a technical perspective, this recent move looks to be corrective only, provided we stay above 7,320. If, however, we were to fall through that level, then the odds are pretty high that we would also retest the October low at 7,258 and the lows going all the way back to March of this year, taking us all the way back down towards 7,204. But as I said, I personally believe that from the technical picture I'm seeing at the moment, the upside momentum short term should last a little longer and could perhaps take us back up again towards 7,484. And the story is quite similar with regards to the German DAX 40 contract. As we can see here, we've been rising since our 14,589 low seen at the end of October on this daily financial bet, and are now grinding higher still and are being capped by not just the orange line here, the 55-day simply moving average, but also by the July to November downtrend line, which actually capped the advance on Thursday, again on Friday, and again earlier this morning at 15,332. Now, here what we need to see is a rise in daily chart close above last week's high at 15,366. And then above there, we've got this key resistance area made up of the July to mid-September lows between 15,455 and 15,575, because that is also where the mid-October high was made. So that's the key resistance area, which would need to be overcome for us to be heading back up again towards the psychological 16,000 area we were trading in back in September of this year. But as long as we stay above the last reaction low today, that's the last low on the daily candlestick, which is lower than the one to its left and to its right, and that was made on Friday at 15,170. Provided we stay above there, immediate upside momentum should continue. Even if we were to fall through 15,170, we could perhaps retest last week's low at 15,067 and even the psychological 15,000 mark. But provided we stay above the October low, the early October low at 14,944, I would expect these moves just to be consolidation phases in a new uptrend. But we'll have to see whether that is the case in the days and weeks ahead. Now, with regards to US markets, you can see here the Nasdaq 100, which has been the great outperformer over the last few weeks since the October low at 14,055 on this daily financial bet. And we can see that on Friday we had another surge higher, taking us to 15,543, which is interesting because that is right within the early to mid-September highs between 15,520 and 628. And earlier this morning in pre-market trading, we came off slightly. And this was on the back of Moody's, the US ratings agency, cutting the US debt outlook from stable to negative due to a significant increase in debt servicing expenses and the presence of, and I quote, entrenched political polarization, unquote, in the United States. But at the same time, the ratings agency affirmed its AAA rating for the US debt, the highest investment grade that exists. So the Nasdaq 100, even though it took a small knock overnight of around 0.3%, may actually continue in its upward movement here. And if it were to rise above Friday's high at 15,543 and also the early September high at 15,628, we could then be gunning for the July high at 15,932. And I expect this to be the case also because not only have we seen a very sharp up move over the last few weeks as the Fed and Jerome Powell are no longer expected to hike interest rates in this cycle, even though Jerome Powell in several speeches last week did leave the door open for rate hikes to be seen. The market seems to think that the rate hikes that we've seen in the US are on pause at the moment and that we will most likely not see another rate hike. And because of that, we have this sharp up move here. And from a technical perspective, what is interesting is that on Friday, we actually managed to close above the mid-October high at 15,339. And because of that positive close, we've actually made a bullish reversal signal. And if that's the case, we should then resume the whole ascent we've seen since October of 2022. And that the phase we've seen since July of this year was just a bull flag, basically a sideways to bearish correction pattern within this longer term bull market. So the technical picture still looks very bullish for the Nasdaq 100, provided we stay above the last reaction low from a short-term perspective, and that is to say Thursday's low at 15,139. So above 15,139, the odds are still pointing towards higher prices being seen with regards to the Nasdaq 100. The euro dollar has been grinding high over the last few weeks, and earlier this morning or over the weekend, the announcement that the US ratings agency Moody's cut the outlook on the US debt from stable to negative did not do much with regards to the euro outperforming the US dollar. As we can see here, we did bounce very slightly on that cross, but haven't really made any headway today at all. As you can see, we have a very small candle and are trading around the or just below the 107 mark, but are still holding and have been doing so since last week above the orange line here, the 55-day simply moving average at 106.41. So further sideways trading is probably in store with regards to euro dollar. But what we can see also is that since early October, we are trading and gradually advancing within this upward trending channel. Now, for the bulls to be back in control, we would have to not only rise above Thursday's high at 107.25, but also ideally above the current November high at 107.56 and the red line here, the 200-day simply moving average at 108.03, in which case we could retest the July low at 108.34. But the advance seems to be quite slow at the moment. And at the moment, we're just trading sideways here. And as long as this 55-day simple moving average of 106.41 together with the mid-October high at 106.39 holds, I would expect further upside to be seen once this corrective move we're in at the moment has ended. And the picture is quite similar with regards to cable. As you can see here, the British pound against the US dollar. Again, we had a minor bounce on that Moody's downgrade of the US debt outlook, but it hasn't taken us anywhere really. And we rallied to 122.53 this morning, but it didn't even come close to the orange line here, the 55-day simply moving average at 122.96, which would have to be taken out together with the Thursday's high at 123.08 for us to be able to head back up again towards the red line here, the 200-day simply moving average at 124.37, which capped the advance in the currency pair last week. Another interesting currency pair is the US dollar versus the Japanese yen, because here what we're seeing is a fifth consecutive day of rises for the US dollar against the Japanese yen. And this is despite the risk of the Bank of Japan intervening, because we are getting ever so close to the October 2022 high at 151 yen and 95 sen. And it wouldn't be surprising if the Bank of Japan were to at least verbally intervene around those levels again. So we'll have to see what happens there in the next few days. But for the time being, the trend is your friend. It's still pointing higher, and the medium-term trend will remain intact, provided we stay above the late October low at 148.81 with regards to the technical view on this chart. The gold price has continued to come off as the US dollar has stabilized, and silver is similar, but over the last few days we have hit some interesting technical levels. But before I look at these, I'd like to very quickly mention the oil price as well, because what we're seeing here is also interesting in that we have fallen and last week slid to $74.92. and did so on concerns over slowing demand from the US and China, the world's two largest oil importers. And as the EIA last week said that US oil consumption will decline by 300,000 barrels per day this year, while economic data in China raised fears of a softer energy demand going forward. And additionally, we also heard that Chinese refiners asked for supply from Saudi Arabia for December. So all of that has led to the oil price slipping with regards to WTI here, for example, below the 200-day simple moving average here in red at $78.01, below which we're still trading. And also the fact that recent worries that the Israeli-Hamas conflict would disrupt oil supplies from the Middle East have also waned. So basically, there is a lot of supply, less demand probably going forward, even though we're approaching winter, and even though OPEC Plus is likely to announce at its November 26th meeting that it will continue to try and cut its output, the oil price seems to be remaining below the psychological $80 mark so far. If we were to rise above the 200-day simple moving average $78.01, we could retest the early October low at $81.21. But basically, provided we stay below there, the trend's your friend, and that's still pointing lower. And it's possible that the decline we've seen so far is now in a third wave with regards to a wave. And if that is the case, we should then be heading back down again towards the sideways trading range we've been in between May and June of this year, between $74.70 and around the sort of $67 mark. So the current bounce we're seeing is probably just going to be short-lived before further downside takes the price of oil lower still. Now, I mentioned the price of gold, and you can see here that we have come off our $2,009 per troy ounce high that we made at the end of October, and have interestingly now tested twice already on Friday and today the red line here, the 200-day simple moving average at $1,936 per troy ounce, which short-term is offering support. Now, given the strength of the recent decline, I wouldn't be surprised that over the course of this week, we will at some stage fall through this 200-day simple moving average, in which case we could test the 55-day simple moving average here at $1,925, and a fall through there would then take us back down again towards the mid-September low around $1,900. Now, resistance with regards to the price of gold comes in between the September highs between $1,947 and $53, and we also have the 24th of October low at $1,953. So that's a pretty good resistance area going forward. And last but not least, the situation is quite similar with regards to silver. As you can see here, the silver price has come off over the last couple of weeks. It was capped around the 200-day simply moving average here at $23.25. And now we're trading in a 2.5-week low, and actually a nearly 1 month low, I should say, because we're trading at levels last seen in mid-October of this year, and have fallen through all the support areas that go back to June of this year, going down to $22.12. At the moment, we're trading slightly below there, and we have the $22 mark as a downside target. And then below that, there really isn't much, as you can see here on this chart. We have potentially a previous high, which can, because of inverse polarity, act as support. That could come in around the $21.31 area. That is a potential downside target. But as you can see here, the trend's your friend. We still have a series of lower highs, lower lows, and short term, we're definitely falling with regards to the silver price. So further downside looks to be more likely than any upside reversal in the short term. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X. My handle is @AxelR_IG.